Hello and welcome. You're watching Business Plus. Following a weekend of fraught negotiations, UBS, the long-standing rival of Credit Suisse, bought its troubled rival in a $3.25 billion deal brokered by the Swiss government in Bern. The president of Swiss Federal Council, Alain Berset, said that the agreement was vital to maintain the stability of international finance. The Swiss National Bank will offer a liquidity line of $100 billion to UBS. Swiss regulators believe the acquisition is the only way to restore confidence in Credit Suisse, a victim of fallout from the collapse of Silicon Valley Bank. The deal did little to placate markets in Asia, which fell today. Joining us is my colleague Karthik, will be joining us very shortly. In the newsroom is Kirtan Shah, who's the founder of Credence Wealth Advisors. But let me come to you first, Karthik. What really brought down Credit Suisse? And was it simply a fallout resulting from SVB, or was there more to it that we know of?
So, Shweta, you're right. I think, the jitters were already visible in the US and banking in general across the world. India has been an exception, but I think we can come to that, some point later in the discussion. But yeah, I think typically the bank run concept is what we saw lead to the collapse of SVB. And that continued to Signature first and Silvergate eventually in the US, even First Republic. And then back in Switzerland, which is actually a banking haven. It's one of the safest places to bank and has been a banking capital of the world for many decades. We saw a similar problem hit Credit Suisse as well. Now, in the case of Credit Suisse, of course, the government was very quick. The Swiss government was very quick to act up, and the Swiss central bank also offered a loan of 50 billion Swiss franc, which is equivalent to about 54 billion US dollars, in a bid to rescue the Credit Suisse bank from collapse. Now, Credit Suisse is among the 30 globally systemically important banks in the world of finance, which means too big to fail. These are banks that you cannot let falter. These are banks that you will have to bail out. But unfortunately, we discovered, a little to everybody's surprise last week, that even this credit line, this bailout package of $54 billion was not really enough to bail out Credit Suisse. So, and of course, knowing that it's a bank which is too big to collapse, it's obviously something had to be done. And over the weekend, in fact, Sunday, the Swiss Central Bank, as well as the European Commission Bank, they all came together. And the decision was taken to get UBS, the bigger of the two banks in Switzerland, to actually go ahead and take over Credit Suisse. Now, of course, Credit Suisse has been bought at a humongous discount. Some reports indicate that it's been bought at a 60% lower value than its market cap, which you mentioned at the start of the story, resulting to a total of about $3.25 billion worth of offtake. Okay. The other story emerging from here is, of course, the fact that $17 billion worth of 81 bonds have been sort of wiped out.
Yes.
And I think that is the story.
I want to come to that in just a bit, Karthik, because there's a long conversation pending on that. We also have Kirtan with us at this point in time. Kirtan, I want to come to you and ask you, what really are the challenges with USB at this point? We know that both USB and Credit Suisse stocks are down, they've slumped. How do you see the dealings of USB? What are the challenges that lies ahead?
Shruti, I think, look, from a market standpoint, I think it is more to do with the trust which is missing at this point in time and nothing to do with the P&L cash flow or the balance sheet, because UBS is very strong when you look at the numbers at this point in time. Of course, the challenge largely is going to be a lot of things which are probably unknown at this point in time while UBS is trying to acquire Credit Suisse. But the government has gone ahead and given a lot of confidence where the government has also said that they'll keep aside $9 billion for any unforeseen events that unfold when UBS takes over Credit Suisse. So from a larger UBS standpoint, I think this is not going to be troublesome for UBS immediately, but it is only going to add value to UBS ecosystem if they've been able to manage UBS the way they have. And I'm hoping that they'll continue to do the same with Credit Suisse on board, because they also have this protection of downside from the regulator if at all some unforeseen things happen in UBS which is not understood, in Credit Suisse which is not understood so far. So I think there is no downside to UBS. But from a market standpoint, the bigger problem is the trust deficit, is because it's not just not just what's happening in Europe at this point in time, but it all started and escalated from the US, right? Where three banks went down. The bigger problem is that, unlike in India, right, where we have a very small number of banks operating, and most of these banks run through a very severe stress test. In the US, if I have to give you some numbers, there are 875 banks, out of which only 25 banks are stress tested. So there are 850 banks like the Silicon Valley Bank, where a lot of risk management is not really dealt with to the most optimum way. So I think currently the market is seriously grumbling with some trust issues of whether or not what will happen to the other banks which are either too large to fail, or the ones in US where the stress testing has not happened. And which is why you see so many of these regulators have come together to pour in so much of liquidity and confidence to the market. But clearly, when you look at the stock market, that's not what the market really thinks, and stabilization might take some time.
Okay. Now, we were talking about 81 bonds, Karthik, and Kirtan, continue to be with us, please. We were talking about 81 bonds, and in liquidation pecking order, bondholders get their money back before the shareholders. How controversial is the decision to completely write off 81 bonds?
So, Shweta, again, when you look at the pecking order, like you mentioned, shareholders come last because they are pretty much owners of the company. The first responsibility of a company when you're getting liquidated or when you're going bankrupt, and any bailout, any package that is offered to you, the first responsibility is, of course, to the debtors. Now, in the case of 81 is actually the additional tier 1. So this is like the top tier of bond holders, except, and it's fairly similar to the regular bonds where there is a fixed interest which is committed to bond holders, and there is of course a time frame, there's a duration to which you hold your bonds. But like we saw in the case of Yes Bank about a month or so ago, even with Credit Suisse, the problem has this time been the very controversial nature of 81 bonds. Now these 81 bonds, what apparently is not informed to bondholders when they are sold a financial product like this. They feel that it's a debt instrument, it comes with its safety net, it comes with an assured rate of interest. What is apparently not told to the bondholders at the time of them purchasing these controversial 81 bonds is the fact that at its own discretion, the issuer of these bonds may withdraw or may sort of throw these bondholders under the bus by withdrawing the interest and in some cases even the capital itself. So I wonder why an instrument like this is actually allowed to operate. Kirtan might be able to tell us better. But from what I understand is the fact that these 81 bonds are not safe bond investments, debt investments. In order of pecking, they should be given preference over shareholders. But like we've seen in this case, $17 billion worth of 81 bonds have totally been wiped out of the books of Credit Suisse. And I've been told that, and these are reports, of course, which are available publicly right now, that the overall 81 bond market in the entire Europe region is about $275 billion.
Okay. I want to come to you, Kirtan, at this point in time. The order of complete write-down of Credit Suisse's 81 bonds came from Swiss Financial Market Supervisory Authority, not from UBS. How do you read into this?
Shweta, I think this was logical, and I've been amongst the only few who've been arguing that what Yes Bank 81 bonds are going through is something that is logical, and that's how it should be. I'm not sure how much time do we have on the show, but to give you an understanding that when you are looking at a bank, risk management is the utmost thing that all of us would really want to look at. So if I have to put context in let's say the Indian banks context so that the viewers can understand this well, Indian banks are expected to keep 11.5% as the capital adequacy ratio of the bank. Now, if you look at this 11.5% that the bank has to keep, it is further subdivided into tier 1 capital and tier 2 capital. So you need to have 9.5% of tier 1 capital and 2% of tier 2 capital to get that 11.5% that the regulators really want. Now, in that 11.5%, the first we said was tier 1 capital, which is 9.5%. Out of that 9.5%, 1.5% has to be additional tier 1 capital, which is the 81 bonds, and the remaining 2% is the tier 2 capital. So what I want you to understand is that when you look at Indian banks, out of 11.5%, which is mandated for the banks to make sure that they have from a risk management standpoint, 1.5% is additional tier 1 capital and 2% is tier 2 capital. Now these bonds, like Karthik mentioned here, are pseudo equity bonds, right? So the rule in India says that if your capital adequacy ratio, the common tier 1 capital adequacy ratio falls below 6.125, then the bank has every discretion to write off the bonds, right, which is the tier 1 bonds. And if it falls below 4, they completely have all discretion to write off the tier 2 bonds also. Forget about 6.125 or 4. Even if the common equity tier capital falls below 6.125, right? Sorry, below 8%, which is the regulatory threshold, then the banks are allowed not to pay interest. Now, look, this is the structure of the bond. This is how these bonds are structured, right? And hence, when you invest, these bonds are expected to default if the tier 1 capital or the common equity capital falls, because this is how the bonds are structured. Now, if you look at it from a regulatory standpoint, right, nobody, including UBS, would want to buy them if there is so much of debt on the books. So if you really have to make this offer sweet for somebody to take over, you will have to reduce the debt. And to reduce the debt, the easiest way is to write off the tier 1, tier 2 capital, because the bond structure says that if your capital adequacy ratio falls, you are free to kind of go ahead and default on the bond. I mean, it's not default, but you can write off the bond. So I don't see anything new in this, and whatever, in fact, what has happened in Yes Bank case in India is also something that was logically expected, in my opinion.
Keertan, if I can come here, Karthik this side, and great connecting with you after a while. Just want to understand from you, so what happens to these bondholders? Do they automatically get converted into equity? Do they become equity shareholders in the bank? In which case, the amount of capital that they would have infused as bonds, as tier 1 bonds into let's say the case of Credit Suisse right now, and with the valuation down, I've been told stocks are down about 63% in today's trade in Switzerland. So do they end up actually getting a better a more sizable basket of stocks if it automatically gets converted into shares?
Karthik, actually not. I'm not sure what UBS probably will propose and how would it go about. But if you go by the basic regulation, it says that if you've not been able to maintain the threshold as a bank on your capital adequacy ratio, you are free to go ahead and write off these bonds completely. And when you
So do
say
you
writing
write
off these
off the
bonds,
bonds completely in terms of the capital, which is the principal invested, as well as the interest, or are you writing off only the interest component for the future duration of holding the bonds?
so Karthik, there are two slabs. Let me
Okay.
explain to you in the Indian context so that you understand or the viewers understand this more.
Yeah.
So let's say the common equity tier 1 capital falls below 8%, right? They can write off the interest payment completely. But
Right.
when the tier 1, but when the common equity tier 1 capital falls below 6.125%, the banks are free to write off the principal amount as well. Now, this is how it is followed in India. The numbers may be different depending on which country are we talking about, but everybody follows the same structure when you talk about a perpetual 81 or an 82 bond, right? So in this case, because the tier 1 capital has fallen below the threshold, I I'm not sure, but as far as I understand, because nothing of that sort has been spoken about at this point in time, but I think the principal as well as interest both are going to be written off.
So what happens to the bondholders in this case? Is there any redressal mechanism? And talk to me in the Indian context, because we've seen the Yes Bank story unfold about a month back. But is there some sort of a redressal mechanism that once the company is liquidated again, or the financial institution is liquidated again and capital has been infused, is there some way for them to get their ownership of those bonds back?
Actually, not Karthik, because there is no collateral kept here which safeguards these investors from a future recourse. Look what happens in equity. You are the owner of the setup, and hence, when tomorrow after you've paid off all the liabilities, if anything remains out of the network, that belongs to the equity holders. But while you talk about fixed income investments and specifically tier 1, tier 2 bonds, because the regulation says that you have the authority as a bank to write it off if it falls below some levels, then you might as well just write it off. I mean, there is no recourse of course, the investors are free to, kind of go and approach law to try and find a recourse like people here are trying to do on the Yes Bank side. But as far as I'm concerned and whatever little I understand about how it works, there technically is no recourse, because the product is structured in a way where if it falls below the mandatory common equity capital, you write it off and it becomes zero.
So another exposure of $275 billion in the European market itself to 81 bonds in across financial institutions. What happens? Do you expect a domino effect like we saw in the US now happen in Europe as well? Are we going to see more chips fall with such an exposure to 81 bonds? Obviously, people are going to want to run and sell off their banking stocks, if not try and get their money back on their investments. So, do you see some sort of a ripple effect as far as the size of such 81 bonds in Europe's financial institutions at this stage?
Karthik, actually, if you look at it, 81 bonds have already got repriced. You look yields already on the 81 bonds are quite higher than what they generally tend to be in the Europe. So the repricing of the 81 bonds have already started taking place. But what all of us have to understand is that not all 81 bonds are going to default, because ultimately it is the health of the banking system in itself that will determine whether a particular bank is able to service those loans and maintain those tier 1 capital requirements that the bank has. But of course, from a market standpoint, I definitely see that a lot of these 81 bonds will get repriced, because that's exactly what had happened to India also. Because when the Yes Bank 81 bonds actually went through a tough time, you had tier 1 bonds of SBI trading at 9.5% yield, where 9 out of 10 people that you will talk to in the industry would tell you that SBI is not going to default, or the capital adequacy ratio will be kept the way it is. But that's how markets function, right? If you've seen 81 bonds of a particular bank go down, automatically there is going to be a repricing, and that's what we've already been seeing happening in the European market. The $275 billion worth of market that you are highlighting, Karthik, is already getting repriced, and the yields are far higher than what they were the last time.
All right, Kirtan, thanks very much for joining us with all those details. We will, of course, continue to track that very important story. But shifting focus for now, India boasts nearly 28,000 startup companies, out of which only 18% have women founders. A report found out among all the unicorns in India, 19% are founded by women. These firms are valued over $30 billion, but there still needs to be more funding. The report, titled Creating 10x Women Founders in India, released on the sidelines of startup-focused TiECon Delhi NCR 2023, noted that women founders have faced an investment loss of nearly $3.7 billion in the last 3 years. Now, that, of course, is a big report there talking about the investment loss to the women and, of course, the challenges that women founders continue to face. We have a quick reaction that we want to play up before we go to our guests here.
Women tend to be more diffident in terms of what their abilities are, compared to men in technology. I think more importantly, the organization should be very, very clear that they look at the talent that they have and they make sure that there is clear career paths in terms of making sure that women can actually embrace those career paths, they are aware of it, and they get the mentorship required to go to that next level. So competence is not the issue. I think diffidence is the issue. And this is something that we really have to work on to make sure that women don't doubt their abilities, and as a result, believe in themselves a lot more, and then knowing that they have all entered the workforce based on competence. Pay gaps are real. I think it starts with the fact that women are not the best negotiators. Okay, so when you're coming in, right, a male counterpart will probably negotiate much, much harder than a woman coming in for the same job. I think that's where organizations have to be very clear. equal, equal pay for equal roles, right? So organizations have to step up to the plate to say that just because I was a poor negotiator, I didn't get dinged, because what it does do is create a culture where you realize that one day, when you find out that your male counterpart who's doing the same job, or maybe not even quite as much as you're doing, is getting paid more, you're going to feel very, very upset about it. So I think organizations have to realize, saying it doesn't matter if you're male or female, but you're doing a particular role, and this is the compensation, and this is the advice I give a lot of people who are negotiating. So when they're asked, saying, okay, what is your current salary and how much more are you expecting? I said, current salary is, please let them know that current salary is not really relevant. What does this role pay, and what would you pay for someone with my experience? That's what I expect of my compensation. So women need to be trained to be much, much better negotiators, not just in terms of salary, but even in terms of startups and, in terms of valuations that they request for and the kind of money that they're raising.
All right, that's Latika Pai there, who we caught up with on the sidelines of TiCon. We have Sakshi Vid joining us at this point in time. She's the founder and CEO of Miles. Sakshi, thanks very much for taking time out. Karthik continues to be with us in the newsroom. I want to come to you, Sakshi, first. Women have to be tough negotiators. That's the big message coming in there. Women founders also face a lot more scrutiny when it comes to commitment and as compared to their male counterparts, which make negotiations all the more challenging. So from what I understand, the ground is not stable. There is no fair play to begin with.
Absolutely, and thank you for the question. I think we have seen this for a while now, that for every dollar that is invested in a woman-founded startup, women have generated about 78 cents. That number actually is only 31 cents in a male-founded startup. And I'm not saying women are actually just superior. I'm just saying there is much lesser being spent, and like you said, more commitment being asked of women in just enabling the startup itself. I think this has to change as a mindset. I think women are still trying to uh, gain the ability to negotiate better. We also, a lot of women also don't come from, the kind of privilege to be able to negotiate better, and to be able to consider it their right. But as we move forward, I think this number has to change. You know, it is being said that in India, if more women were funded, or they were part of the organized workforce, they can add about $770 billion into the economy by 2025. Now, that's a number that we should really be driving.
Okay. The study also found that female founders are a lot more cautious. I think that's more general of women, when it comes to dealing in business, when it comes to dealing in workplace. What makes women more cautious, and how can really women work around this?
I think I believe that not only are women more conscious, they are more reasonable in their assumptions of what they will receive. And I think this cautiousness also comes from the fact that there is a paucity of funding for women startups. The more liberal we become towards enabling women startups, or rather just more diverse setups, it will become easier for women to be able to demand more money. It will become easier for women to be able to bring about ideas that are more magnanimous in terms of the outlook. A woman founder today tries to look at more B2B businesses, because the chances of creating profitable, closer part to profitability ventures there is a lot higher. And I think women are taking lesser bets right now in terms of the B2C ventures, unless they're completely female focused, primarily because of this reason. So I think the uh, the number of opportunities, the number of female-centric funds which are now coming up in India as well, will release greater opportunity for women to be able to actually take steps that are less cautious.
Hi Sakshi, this is Karthik from the studio. Wonderful connecting with you. Help me understand, how is it for a woman to actually go and pitch an idea to a VC? Do you think there is some sort of a resistance as soon as visiting cards are exchanged, or as soon as the first handshake is done, as compared to your male counterparts?
So, honestly, I have not faced anything like that at the time when you're presenting a startup. I think most VCs are now more and more open to discussing all kinds of ideas. Subconsciously, though, I think all VCs do tend to connect on saying, if you're a female founder, do you have other co-founders with you? Are they all also female? Or do you have a male co-founder as well? I think those things sort of do come about subconsciously. I think there is also a certain amount of resistance in saying when an idea or an industry that a female founder is presenting is not traditionally considered female oriented. There is a resistance then in understanding how you're going to be able to do it. um, but I think I have actually seen some pretty brilliant women in the startup space in India in particular, and of course in other parts of the world as well, who have been able to break those barriers, break those mindsets, and really be able to prove themselves even in the VC community.
All right. There are many stereotypes related to female founders, especially female founders who go on to raise money and who go on to be successful. One of them is that 8% female founder startups deal with deep tech, which is, as compared to men, 11% of all men founding startups. Essentially meaning that women are now in every domain, be it deep tech, be it, extensive, any domain that requires extensive study, extensive legwork. I want to understand from you, as a founder yourself and as a woman founder, what are some stereotypes that you come across on a daily basis?
I think one of the first things that I do come across is when a lot of my male colleagues, and this is something that we work towards very consciously, when male colleagues start trying to understand which role is meant for women and which role is not meant for females. And I think that is something that, whether it is field jobs or financial jobs, etc., there are still certain thoughts that come or creep in really in the thinking. Although I do believe that the startup community has become a lot more liberal even in the Indian context, because we are dealing with very large teams. There is funding coming in all sort of spheres, and therefore roles have to open up for the other half of the workforce itself, because it exists and we do need to grow at a extensive space. So now I think we're literally trying to break stereotypes just by the uh, because the demand exists, and there is a need to have more people, more capable people. We need to cater to a larger market. I think where India also becomes interesting as a market in breaking stereotypes is because the more diverse the workforce, the larger the market you can cater to or think about from a business expansion perspective. So I think those are changes that are probably happening.
So these are changes which are already taking place. But Sakshi, going forward, what more needs to be done? Because I don't think reservation is a great idea. I don't think any undue unleveling an already unlevel playing field in the opposite direction is a great idea. So as an ecosystem, what else needs to be done? Because I mean, you've got to stand for equality, of course, which I understand and appreciate. But yet we don't see the kind of fillip that women startups deserve is still coming through.
So I agree with you that I don't think the balance needs to shift now in the other direction, just to make sure that more females come onto the startup space or are funded more. I think what although needs to happen and is happening is that we are at an inflection point where everyone is trying to understand what really needs to be done. Which is why you see certain recommendations or policies related to reservation, or just things like extra leaves, etc., which are sort of the part of how culturally organizations or any economy tries to change towards the other side of the workforce. What I think is very, very important though is one, there should be more female focused funds for sure, because I think female focused funds are definitely able to bring up the right minds out into the market. They are able to fund the right kind of startups. They are also able to bring the community together really to be able to get the community to think differently. So the points around how do you negotiate better, how do you get the right price, how do you get the foot in the room more than the men do, etc. These are things that happen when closer communities get built up. So I think that is something that definitely needs to happen.
All right, Sakshi, thanks very much for joining us with all those details. We're going to shift focus to another important story that we're tracking here. The Indian aviation industry has been making the right noises this year, primarily because of the jumbo order placed by Tata Group-owned Air India. However, it is going to take some time for the airline to turn a corner. A report by aviation consultancy Kappa India notes that Indian carriers are set to post a consolidated loss of $1.6 to $1.8 billion in the next financial year, highlighting the grim operating conditions of the airline in post-COVID times. Although airlines are placing orders and there is positive buzz among stakeholders, the outlook for some airlines does not look very promising. We have joining us right now is Ameya Joshi, founder of aviation analysis website Network Thoughts. Also with me is Shweta Kothari, my colleague here. We are discussing what exactly are the air pockets faced by Indian aviation space. I want to come to you quickly, Shom. You've been tracking this space very, very closely. Will we continue to see only two robust carriers? What are the options do we have apart from Air India and Indigo?
Thanks, Shweta, for having me on the show. Unfortunately, this year, Jet was supposed to take off, and Jet and other airlines, SpiceJet and Go First, the budget carriers, they're still struggling for the headwinds they're facing post-COVID. And obviously, there's a positive euphoria regarding the airlines' recent orders. We've seen Air India placing a jumbo order, then Akasa also stating that they're going to place a 3-digit figure deal for the airlines, and Indigo is also going on the same path. Yes, but from a consumer point of view, I think placing orders it's not going to place much difference to them as long as we have only two robust carriers, because until unless you have more options, just like the telecom space, they'll be forced to choose between 2 or 3 carriers, which doesn't give them much of an advantage in terms of pricing, in terms of alternatives, in terms of choosing their favorite airline. And with Vistara also one of the favorite airlines of a premium customer, it's also going to be merged with Air India. I think in a vast country like India with 144 million passengers, that's 10 times growth in 10 years from 2013, I think we deserve more carriers and more choices for passengers.
Okay. More choices there. But keeping the Air India order aside, how do you think the sector can navigate? And let me get Ameya in at this point in time. How do you think the aviation sector can actually navigate the turbulent phases triggered by geopolitical headwinds and the global supply chain disruption, Ameya?
Thanks for having me on the show. So you have to look at the cost structure of airlines in India. If you look at it, we have about 38 to 40% of the entire expenditure linked to the aviation turbine fuel. All of this is exposed. You also have your entire aircraft fleet mostly leased, the payments for which are dollar denominated. And we all know how rupee has been sliding. It has slid about 10 to 12% over the last 1 year. So everything else remaining the same. Just the sliding rupee means that your outgo, which is in dollar denominated terms, has gone up 10%. And that is where airlines get hurt. ATF on one side, dollar denominated expenditure on other, and they have no choice but to increase fares. Now, so far there has been revenge tourism. You will see that a lot of people are still coming in even at higher fares. But how long will it continue? The geopolitical angle does come into picture, but if you look at Air India, it has impacted them positively. It is the only carrier which can fly between India and North America non-stop by overflying the Russian airspace. You had other carriers like Air Canada, United, American, all of which earlier overflew Russia, and today because of geopolitical reasons they cannot. Neither do we have as many planes which can do a detour and reach India because it's a long sector, and nor do you have that kind of economics to do one stop, because then you compete with the likes of everybody else. So geopolitical impact has been a positive sign for Indian carriers, especially Air India, because they are the only ones who are operating non-stop to North America. From a cost perspective, it's a challenge, and that challenge remains true for every carrier in the country.
Okay. The airline business has always been a risky proposition, but despite this, we've seen success stories. We've seen Indigo as well as Kingfisher, later Jet. What are the factors ailing the sector right now? If there were success stories in the past, I'm sure it can replicate in the future. But what exactly is ailing the sector, all in all?
Yeah, definitely. So there have been success stories, but then you have to ask how long does that success go? Because if you look at last 20 quarters, Indigo has made a loss of 13,000 crores and SpiceJet has made a loss of 5,400 crores. Let us look pre-COVID. So it wasn't that pre-COVID, the last full financial year before COVID, Indigo recorded a profit of 156 crore, whereas SpiceJet had a loss of 316 crore. So it's not that people have been making tons of money in a sector where it's more like I want to be in that sector mentality for say Jet Airways or Kingfisher, both of which do not operate right now. But it has been Indigo which has consistently kept its head down and grown to where it is today with over 50% of the market share. If you look at specific areas which aid, it's the cost structure. If you have a better cost structure, if you manage to get fuel under GST where you have a standard rate across the country, there is going to be a lot of benefit. If there genuinely is incentive to go beyond dollar denominated pricing for leasing and encouraging Indian carriers to lease out of gift city where there are tax benefits, these are the small things which will start impacting positively to airlines, and eventually the cost will be passed on to the end consumer, where flying will be a little cheaper than what it was or what it is right now. Everybody has been complaining of higher airfares, yet you see planes being full. The load factors are 90% plus on a daily basis. How long will that continue? We'll have to wait and see.
Right, Amya, that's interesting. The irony of the whole situation seems to be the fact that we are back to pre-COVID levels in terms of passengers, right? Air traffic in terms of number of people flying, we are higher than what we were pre-COVID. Prices have increased. So, of course, fuel prices have risen. They've also come down. I don't know how much impact has been there on ATF per se, but overall globally fuel prices have also cooled down. But prices are increasing. There is higher competition. There are more number of options available. It's understandable that prices may not go up significantly because of the competitive environment, but at the same time, we are also alluding to a duopoly kind of a situation where Air India and Indigo are touted to be perhaps the only survivors. So people are paying more. Fuel prices have overall globally come down. Number of passengers taking to the skies are much higher. How difficult is it for an airline to actually have a business model that makes money? And I'm reminded reminded of what Richard Branson had famously once said, that the easiest way to become a billionaire is to become a millionaire is to start an airline as a billionaire, lose money, and you will end up becoming a millionaire. So what is this dichotomy? I mean, it can't be that, it can't be rocket science to make money in the aviation business.
Well, turns out it is rocket science to make money in Indian aviation, at least, if not overall aviation business. But yeah, I mean, if you look at it, why we are having higher load factors, passengers, and passenger numbers very close to pre-COVID levels, is that we have lesser planes. So you will see the load factors are higher because we are doing as many passengers as we were pre-COVID, but with lesser number of flights, which obviously simple maths translates into more passengers per flight. And there is dynamic revenue management across airlines. So as the flight starts filling up, you will see the prices going up. So yes, travel is back. Part of it is revenge travel. Part of it is business travel coming back. But because you have lesser planes today, and that is also because about 50 to 75 aircraft are grounded for different reasons. We have a fleet of 701 commercial aircraft in the country. About 75 are grounded at any given time because of engine issues, largely for Indigo and Go Air. So that's where the crunch comes in. And you see that your planes are full. Because your planes are going full, the revenue management practices push you towards getting the fare towards the upper band of it. But you're still having people. Now, where does it go from here? When the engine issue gets resolved and you have more capacity, how are you going to price yourself? Can you still price like this, or because you have additional capacity, airlines will be forced to drop the pricing and then attract people? And that's where is the curve from where if you start sliding, you start discounting and you want more passengers for the sake of lower revenue, or do you want to hold on to the fares, have lesser passengers, but go towards higher revenue and break even? That's an eternal jugglery which keeps happening across airlines. At least in India, the profits are as thin as boarding passes, and we have had so many swings over the last many quarters that you can't really predict and say that this is a profitable quarter. And that's where the whole jugglery lies, at least in Indian aviation. So to say that, no, why can't we really crack this puzzle is because the nature of the game that is in India,
Right.
and that's what makes it difficult.
All right. Thanks, Amir, for joining us with all those details. We're going to move on now. Almost half a decade after Article 370 was revoked in Jammu and Kashmir, the Union Territory has landed its first foreign direct investment. The Emaar Group, the makers of Burj Khalifa, will build a 10 lakh square feet mega mall of Srinagar, and an IT tower on the outskirts of Srinagar. Lieutenant Governor Manoj Sinha performed the groundbreaking ceremony for 500 crore rupees project that envisages creating over 10,000 jobs in the valley. The Mall of Srinagar will reportedly have 500 shops. Many of those are expected to be run by UAE-based companies. The mall will also house Abu Dhabi-based group Lulu, which runs supermarkets across West Asia. Amit Jain, the CEO of Emaar Group, said that the group's entry into Jammu and Kashmir will have a ripple effect, adding that other companies from Gulf region are also looking at possibilities of setting shop. Joining me with all those details and to add to it more is Furkan Mohar Khan, who's the author and banker. Furkan, thanks very much for taking time out. I want to first begin by asking, one of the reasons cited by BJP for revocation of Article 370 was the fact that this particular article was impeding development of Jammu and Kashmir. What sort of development have we seen in J&K post the revocation?
So, let me tell you, there are three facets to this question. Thank you, Shweta, for getting me here. So, there are three facets to what you asked. Was Article 370 needed? No, it existed just in the piece of paper. So, we needed to get done with it. So, one part is that. Second, did it cause impediment to the investments? Yes, it did. Why? Because you could not acquire land in J&K. Only route through which you could have acquired the land in J&K was through lease, 99-year lease. So my designation, by the way, is wrong. I'm not a banker. I'm a journalist. So
Corrected.
Another part of the question is, did it impact the investments coming into J&K? Well, numbers don't suggest so. If you look at the numbers, the highest investments that have come to J&K are still way back into it. Investment, I'm talking about investment proposals first. The highest amount of investment proposals that have come to J&K were in 2017 calendar year, 1,008 crore worth of investments. And the highest implementation of investments during a calendar year was in 2018. 958 odd crores. So these are the DPAM numbers. So we don't know how it will reflect. So Article 370 clearly has cleared some of the abrogation of Article 370 has cleared some of the impediments in the which were acting as a roadblock to the investments in J&K. But this is just a baby step. There is you have to give the investors a sense of security. It has to have a infrastructure there. I'm not talking about only infrastructure in terms of roads and everything. We need to have financial infrastructure. By financial infrastructure, I mean capital markets and the banks, which is lacking in J&K terribly. And we are at the bottom of the rung there.
All right. How big of a deal is the entry of Emaar and Lulu Group in J&K? Because this is the first tranche of an FDI investment that has come in after the revocation.
So I'll talk about two separately. The first, let me talk about how I place Lulu's investment at a higher pedestal than Emaar's investment. So Lulu's investment is into, if you see, food processing unit. Now J&K, at core of it, horticulture contributes a lot to the economy of J&K. Food processing can be channelized into a proper and full-fledged business in J&K. It can be, it can be a secondary sector business where actual manufacturing takes place. So it can create a lot of ripple effects. It can benefit farmers as well as, it can take the Kashmiri products across the globe. Now, when it comes to this thing, having mall built by this thing, mall and the IT tower built by MR Group in J&K, well, it has to be seen because it's a consumption based business. Malls, across India, we have seen a lot of malls closing and not doing well because it's all based on the footfalls of the
Right.
customers.
Right.
So, it's we'll have to wait and watch there. And IT, for they have said that they would be investing 150 crores in an IT tower in Jammu as well as in Kashmir. So you need occupants for that. I mean, they will build an IT tower. What is the benefit of that IT tower if no company comes to J&K
Of course.
to occupy space in that? So
Okay.
that has to be we have to wait for it to see how it shapes out. But Lulu's investment, given the fact that it is based on something which already the Kashmir can provide benefit on. So I mean, this is a good launching pad, Lulu's investment there. It can trigger, and they have also plans to open up, by the way, logistic center there. So I think the other sector which can thrive with that is infrastructure. Right now, if to be honest, to be candid here, if something happens on the Jammu Srinagar highway, the Kashmir is cut off from the rest of the country for a week or so. So that has to be improved for business to thrive in that place.
All right, Furqan, thanks very much for joining us with all those details. We, of course, need more business to thrive in the Union Territory of Jammu and Kashmir, and Emaar and Lulu's entry there is going to mark a shift as far as investment into the Union Territory is concerned. That's all we have in this bulletin. Thanks very much for watching. Stay tuned.